Hey guys, Value Venture Investing here today. So what we're going to do today is we're actually going to do a valuation on a Tesla. I didn't want to do this video quite yet because I wanted to give you guys the tools to see what I'm doing first, but I felt like this is an appropriate time to put it out. This is kind of in response to Financials Education's video saying that he thought Tesla was going to go to $3,000 a share. I've also heard some analysts say that as well, $3,000, $4,000 a share, something like that, and I've seen nobody do a valuation on it whatsoever. I understand why. It's a very difficult valuation to do because we don't know what's going to happen in the future. We don't know what the different line items on, Tesla's income statement balance sheet are going to be like. But that being said, you can make assumptions about what you think is going to happen in the future based on very lofty expectations or very, bearish expectations. And you can do a valuation and see what's the potential. What, could we get to $3,000 a share? So I wanted to kind of look at that today, do a quick little evaluation on it. But I wanted to give you guys some caveats first. I wanted to let you know that this is very difficult to do. So, don't be too hard on me. I've made a lot of assumptions, and if any of these assumptions are changed in just, the teeniest amount for 10, 12 years, it can make a huge difference, right? We don't know what's going to happen. We don't know what they're going to do with their debt levels. We don't know what they're going to do with their shares outstanding, all this kind of stuff, right? But I've made a bunch of assumptions, and I think the assumptions I've made are extremely fair. In fact, I think they're too fair, and that's why I did it this way. I base a lot of things on historical levels, meaning I average out what's happened in the past and I project it out into the future, and then I've changed it in the future based on certain things that have happened. So let's do this Tesla valuation. Let's look at the assumptions here first I made. The first assumption you have to put in your head that the financial education talked about was that the US sales are about 16 million. And he's right in saying that these are probably going to fall. I mean, we see a lot of this ride sharing, these different types of things that are happening in the US. Other companies are pushing into this hard. So that's an assumption that you got to keep in mind, right? But specifically the Tesla assumptions, I'm assuming that they're going to be an average $50,000 price car. Now, some people might make the assumption that, it's going to be up, the average is going to be higher, but I'm saying that's an average. You got to keep in mind that there's a lot higher, there's a lot lower. Yeah, car prices might go up in the future, but even as of right now, we don't even have below $50,000 car, right? We hope that they'll bring a $30,000 car, they have that plans for that kind of stuff. But right now we're at that, and they're pushing much higher, $200,000 cars and stuff. So I think it's very fair to say they're doing $50,000 a car on average. And also in this assumption, I put, the financials into related activities. Now related activities is like their, the gigafactory, their roof tiles, power chargers, the superchargers and whatnot. So that you just keep that in mind that that's there as well, because that's way too difficult to try to pull that out when they're not really doing enough right now with that and do a different valuation on that. That might affect gross margins, and I've considered that, but we'll get to that in a little bit here. So about the growth, I figured the growth is probably the most important thing, right? Of course. So they've been about, for the last 4 or 5 years, about 56% year-over-year growth, and that's massive. Those are huge numbers, right? So I made the assumption that they would stick at those levels, those historical levels. 56% year-over-year growth until 2023. 2023, this is about, when they're going to become profitable. Somewhere around there, I'd have to look at my spreadsheet, which I'm going to show you guys in a little bit. And then after that, they're going to have 30% growth year over year after. Now that's, again, 30% every year. That's huge. So I think those are very fair assumptions to make with Tesla. Not like it's going to be going up 100% a year. We got to be realistic here, right? And I don't think this is even very realistic. Gross margins are going to remain at 23%. Now, this is one thing that, some people might argue that the gross margins are going to get higher because it's more of a tech company, like they're going to be around Apple's, 38%, but it's not going to happen. These are cars, right? If you look at the actual other divisions that we were talking about here, the related activities, the gross margins are actually lower. They're like 12% on their energy division and stuff like that, right? But right now their vehicles are around, on average, 23%. That's an amazing margin for vehicles, right? Ford, you're seeing like 5% gross margins, GM 6%, Honda 5.5%. If you look at an actual strictly luxury vehicle, like the elite vehicle, Ferrari's only at 19%, right? And that's all they sell is the like $400,000 cars, right? So to assume that they're going to remain at 23% throughout the whole valuation, that's extremely fair. It's too fair, I think. Research and development is going to remain at average levels. At 2023, it's going to then drop and stay at 12 billion per year. Now, Apple's around 11 billion per year right now, and it's around this time that they're going to have about the same amount of revenue as Apple, you know, in the assumption that I'm making. And so these levels are very fair. And I think that arguably Tesla's going to have to have much more higher levels of R&D than Apple to put this kind of technology into the vehicle, to do the things that he's doing. They're just so outrageous. It's not like building a phone and outsourcing it to, you know, Foxconn in China. It's a lot more, right? Selling general and administrative expenses are going to remain at average levels. And then by 2023, they're going to drop to approximately 8% of revenue. Now, others are about 8% of revenue, so that's very fair. I think that's a fair assumption as well. Interest income is going to remain at, you know, historical levels. That's a very difficult one to, you know, to do projections on, so we'll just keep that at historical levels because we don't know what they're going to be doing with investments and stuff. Interest expense is going to remain at the historical levels until 2025, and I picked 2025 because that's when a lot of their bonds are going to be due. So it's very fair to assume that they're going to have the same interest expense until 2025. In fact, I think it's going to be even more because they're going to need to raise capital here. I mean, it's just a fact. If you look at their, look at their statement of cash flow, they burned through over $1 billion in the last 6 months. They've only got about $2 billion in the bank on the balance sheet. They're going to need to raise capital some way, whether it's through debt or equity, right? So after 2025, they're going to drop to 1%, which I think is very fair. I mean, to a company that's going to have this kind of phenomenal growth, 56% and 30% growth, they're going to need money to expand. And you look at other companies, like a lot of people like to compare them to Apple. Apple's about 1.5% of revenue on their interest expense. Ford's about 1%, right? And Ford's doing a lot behind the scenes that people don't pay attention to because it's not being tested on its customers, right? They're spending a lot of money. The big thing here too, equity market raises are going to stay at 10%. These are historical levels. So by 2030, they're only going to have 572 million shares outstanding, which I think is very unrealistic. I think they're going to have billions, like you look at other big companies, Ford and whatnot, to get the level it's at, GM, billions. Apple, billions, and they're buying it back as fast as they can with their billions of dollars in the bank. So these are the assumptions that I made. I think that they're very fair. If you have any issues with them and you want to talk about them in the comments down below, I mean, I'd love to hear them, but I would like to know why, and I'd like to know the numbers rather than just, a generic response that, well, you're wrong. You have 50% of the global market or something like that. So let's take a look at the spreadsheet right now. You probably don't want to take a look at the whole thing because it's a lot of numbers here. But basically what I've got here is from 2013 to 2017. These are the real numbers, right? I mean, these were their real gross margins that they have here. All their, expenses that I've taken to project out into the future, right? And as we've seen, the shares outstanding have increased. The net income has definitely decreased a lot. 2018 is not over yet, but I think it's a fair assumption to say the revenue is going to be about 12 billion. So to say that they're going to grow 56% year over year, well, we're not even seeing that here. But that's the assumption I was going to make. So we keep going out here, and I projected out way into the future, but I have a certain times that I want to show you. So approximately 5 years. So in 5 years, according to these projections, they're still not going to be profitable. Could be wrong, absolutely. We don't know what's going on with this company, but I'm saying in 5 years they're going to have over, $93 billion in revenue. That's a huge assumption. They're going to have net income of a loss of about 2.8 billion. So I think they're still going to be losing, right? And they're going to be at about 293 million shares that are outstanding. 2024 is my projection, the year that they're actually going to become profitable, given the assumptions that I just laid out to you guys. So by then they'll be making over $120 billion a year. That's a huge number just by 2024. And they're going to basically have a net income of a little over 1.3 billion and earnings per share of $3.16. But what I'm really concerned about, or interested rather, is 10 years out and further. The 10-year mark, as you can see here, they're going to have almost $350 billion in revenue. Apple doesn't even make that right now. So they're going to have net income of almost $29 billion, and they're going to have $60.73 earnings per share. 10 years. I cut it off at 2030, so 12 years out into the future. There's a couple reasons for this. One is this number's being thrown around that they're going to be making, anywhere from $500 billion to $700 billion in revenue. Well, given my lofty assumptions, they're going to be making, $588 billion in revenue by 2030. And they're still going to be maintaining that 23% gross margin. So by this level, you know, they're going to have, you know, net income of $55 billion. And like I said, they're only going to have a little bit over 500 million shares outstanding. By this time, they're going to have $96.29 earnings per share. So the question is, how do we do a valuation from this? I haven't taught you guys a lot of this yet, but we'll take a look here. I'm going to erase the board and I'm going to put in these time increments and we're going to take a look at what we get. Okay guys, now let's look at the actual valuation of this company. I wanted to start this off with this little chart I have here because perhaps I wasn't too fair on the profit margins. I was basically giving the profit margins before on the other whiteboard about their net profit margins, but when it's actually more fair to do the gross profit margins, which are a bit higher, because I was comparing to Tesla's gross profit margins, which are about 23%. But the reason I did that on that other board was because, you know, I think it's fair to assume that the profit margins are going to get pulled down. And we're going to be looking at gross profit margins or net profit margins, but these are the gross profit margins of these companies, so it's a bit higher. So I wanted to keep those in mind as well as we went through the Tesla valuation. So the easiest way to evaluate is we just give it a multiple. I mean, we can't really project out future cash flows in terms of, you know, dividends coming back or anything like that because it's just so far in the future. I mean, we can't do this. So we got to look at what kind of multiple it could have. So again, we're going to go by 2030 because I think that's a good, you know, a good point. It's about 10 years, about 11 years in the future, somewhere like that. So the assumptions based on my model is they have nearly 12 million units sold. So 12 million. Again, remember how many were sold in the US alone. So when you look at some of the competitors here, right now, we have huge heavyweights. Toyota selling about 10 million, approximately, these are approximate numbers, guys. 10 million a year. Worldwide. Volkswagen, 10 million. Ford, 6.6 million. GM, about 10 million. And you're going to tell me that Tesla, you know, in 11 years is going to be selling 12 million units worldwide, you know, more than any of these competitors who have luxury brands built in. I mean, some people might make the argument that, you know, well, Tesla has the luxury brands, they've got the sports car. Well, you know, Volkswagen has Audi, you know, Ford has Lincoln. I mean, they all have their, you know, luxury brand, and you can, you know, make the argument that, well, Tesla's is going to be so much more, but Tesla's also competing on the, you know, the lower end too. That's where their push is going to be now. So that's a huge assumption that's built into, you know, my numbers there. And that is derived from the revenues of $558 billion a year. So that's based, of course, on the $50,000 a year, or $50,000 a car Tesla. Again, net income is going to be $55 billion, and earnings per share is going to be about $96.26 a share. So like I said before, the shares outstanding are going to be 572 million, which I think is ridiculously low for a company that's deriving this kind of revenue and this kind of market share, you know, trumping any of these ones that, you know, that are in the market right now. So here's the actual valuation that I did. Okay, at 20 times earning, which I think, you know, in 11 years, I mean, that'd be lucky. Look at Apple. Look at the growth potential that Apple has right now. People like to compare it to Apple. And it's trading at like, what, like 17 times earnings? You know, at some points it's like 14 times forward earnings, stuff like that. So I think that's, you know, pretty fair. At 20 times earnings, that's going to give Tesla $1,925 price target based on all these lofty assumptions. However, that's in the future. You know, that's 11 years in the future. So you're going to have to discount that back to the present value. That's the only fair thing to do. And if you guys don't quite understand that, it's the fact that why would you pay $1,900 for this share today when it's going to be worth that in 10 years, 11 years, right? So you have to discount it back. I use a very appropriate discount rate of 10%. Because, you know, the markets themselves on average go about 10% a year, but that's a very, if you know anything about that kind of valuation, you know, the security market line kind of thing, that's a very fair discount rate. So that would bring it about $674 per share today. So that's, you know, that's a huge premium where it's at right now, right? But we're still not at that $3,000 a share. So let's give it a 50 times earnings. So that's making the assumption that, you know, of all these grandiose assumptions, that in 11 years when it's grown that much, and I don't think it would have any more room to grow from there, well, not much at least, given the fact that, you know, the trends of, you know, people not using vehicles and stuff in the futures might continue. Say 50 times, people then think, no, it's going to go, it's going to be making way more money. It's trading at 50 times earnings. That's going to be $4,814 per share in the future value. Present value, that's $1,687. So we're still not at that 3% or that $3,000. I mean, I find that very difficult to get to that $3,000 a share. I find it myself very difficult to get that 674 a share. But if you were extremely ridiculously bullish on the company, you might be able to say it's worth $600 a share today, right? Some of the reasons that people give, there's a competition. You know, they say, where's the competition? I agree, the competition really hasn't stepped up yet. Tesla's killing it, right? But I mean, you know, the e-tron, the F-Pace, the Mercedes, these all have like the same amount of range. They're faster, they're gonna be cheaper. And you tell me that these big boys, even these old ones, are just gonna lay over and die and let Tesla take 12 million units per year and just eat out all theirs? I don't think it's gonna happen, right? Again, capital raises. I'm not even talking about what's happening right now. They need to raise more capital. And given Elon's, you know, investigation that's going on right now, I don't even know how they're gonna have, you know, gain capital, because you can't be doing that when you're under SEC investigation. But you know, that's a whole nother target. But this is a huge component of it, right? And of course, this is probably one of the biggest one, the futures trends, why this number of 12 million units might be a little hard to fucking, you know, to get there, because Uber, you know, Ford's investing billions in ride sharing. I mean, there's tons of statistics and data out there that's saying that people are just generally not buying cars like they used to. Things are different as urbanization comes in. You know, I mean, people are using more mass. They're using Ubers. They're using mass transit, things like that. But you know, on this model that I assumed there, I made the assumption that they're going to continue to sell as many as they did. But this is a huge risk as well. So you know, given all that, I think it's very fair. You look at the revenues. I'm projecting 558 billion, whereas right now the total revenue of all these big dogs is only 789 billion. I don't see it happening. It's very difficult. So to get a share price of 3,000, my consensus is no way. Super bullish, maybe $600 a share if you're super bullish on, you know, you agree with my evaluation, but I don't think it's going to be there at that level anytime soon. Anyway, I hope you guys enjoyed this. You have any questions, leave them down below. Again, be nice to me, because there's a lot of assumptions I made in here. A lot of these numbers are difficult to get on. These gross margins are difficult to get because they have a lot of other components in these companies as well. They're sometimes mixed in. So it's a very difficult evaluation to do, but I think I did it pretty well, and I'd like to know what you guys think. So that's going to be it for today, guys, and I'll see you in the next one.